for inviting us. It is an honor and a privilege. My name is Brenda Cho, and I have been with Hudson United recently in January, started in January, and we're very excited. We have a team here of expertise that we brought. Today we have a huge team, but today we brought Pat here, who is an expert in commercial. He also does all kinds of loans. So he's amazing with whatever he can do to help. And I'm actually in real estate, the residential area. So I thought it was a good situation for both of us to come and to give you some guidelines. And one of my passion is that we are able to, I believe that knowledge is power. I know that many of you know that knowledge, having information is powerful. This is how we learn and we grow together, and so this is why we're here. So we want to teach you, not teach you, but to give you some guidelines, because you're not a mortgage advisor, so that you know what it is, so that you can help and promote your business. So, Pat, come in.
I'm approaching about 2,000 individual transactions for co-op, so my background was always residential. And how I got into commercial, I think, is a little bit interesting. I used to get phone calls from people I did mortgages for that were apartment owners, and eventually I became friendly with people that were on the boards. They would call up for what's called an underlying mortgage, which is the mortgage for the entire building. So you think about buildings need facade repair, they need HVAC repair. A lot of times it's either hundreds or millions of dollars for those types of loans. So I periodically got phone calls on that, and I would refer it out. And eventually, after probably 5 years and 50 phone calls like that, I decided I should probably look into this, and it always kind of intimidated me. And I guess one of the takeaways that I want you to have today is to not be scared by it, because it sounds intimidating. I found out that commercial is just another form of lending. Same thing for commercial real estate. It's another form of real estate sales. So there's still prospecting, there's still negotiating, there's still selling, but the basics, the fundamentals are really the same. So what differentiates commercial lending from residential is the property type that's 5 units or more, or has some commercial influence, that we refer to as mixed use or commercial. So you think about an apartment building. If it's got 4 units, Brenda can work on it. We sell that loan all day long to Fannie Mae or Freddie Mac or any of the banks we have relationships with. And if it goes 5 units or more, most of those lenders don't want to have anything to do with it. So we have to have a special group of lenders that will help with that type of financing. So if you flip to the second page presentation, you'll see the asset classes or buildings that we can help with. So again, the one you'll come across most frequently is an apartment building that's 5 units or more. And again, it's a small complex, but it falls outside of residential. So the financing is different, the down payment requirements are different, credit standards are different. How we evaluate the property is totally different than it is for residential. Does anybody remember how lenders look at financing a residential multifamily? We take into account the borrower's income, right? We look at the rent and we look at their credit. With residential, we have to do what's called a cash flow analysis or debt service coverage. So we make sure that the operating income for the building covers the mortgage. And that's a really extensive calculation. So when we go through this, we just look at it differently. And again, it's a little bit more time consuming. So you'll find with Brenda that you can call her up and ask her about a property. She can qualify somebody within a half hour or an hour. With the commercial side, it takes longer because we need more information to filter through. So again, we do the multifamily, we do mixed use. So you think about a 3-unit building. It has a florist on the first floor and 2 apartments on the second floor. Don't walk away from it. We can help you finance that. So that's something that in the past you may think that's a little bit challenging. It is. It's a different buyer. It's a different transaction, but we can help you with that. And all you have to do is pick up the phone and call. The types of programs, if you flip to the third page, the source of funding, again, is a little bit different from what it is on the residential side. So the classic loan right now is with the portfolio lender. So you think about a company like Bank of New Jersey. They're one of the companies we work with, and we can call them up and go through the transaction, and they could say, yeah, we want to do it, or that's something that's not of interest to us. So we've got 60 different lenders that we currently represent. And everyone has their own niche. Some like multifamily, some like warehouse, some don't like either of those. But we have to filter through that and figure out who's got a strength in a particular area, and then we go back out and shop the rate and determine what the best product is, the best program for the borrower. The second type of loan is an SBA loan. So getting back to the floor, so you have somebody that maybe wants to become a business owner and they don't have the capital, they don't have maybe the experience in it that they need. The SBA is actually a government program that helps somebody actually create a business. So the basics of that are we need somebody with a 10 to 15% down payment, but they have to sit down with our person and write up a business plan and really come to a conclusion about whether it makes sense to buy the business or not. But it's a great way for somebody to get into a property with not a whole lot of money and become a business owner, because a lot of people today, they don't want to work for the corporations anymore. They want to become self-employed and control their destiny. So SBA is a great way to do that. Getting back to the land loan I referred to on the first page, tied in with that is a construction loan. So we periodically get phone calls from people who own a building, or they want to buy a building or buy a lot, and they want to build a condo project, like a small one or maybe a bigger one. The bigger ones typically take some sort of background in development for us to be able to help them with that, but there are smaller ones that can help out. So we've got a transaction right now we're working on. People own a 3-family, they want to raise it and build a 6-unit condominium. So I called up our construction lender, walked them through the details of it, and they said, that thing should work. It's actually a transaction they like. So again, if you find something, the takeaway here is don't walk away from it if it's something that you're not familiar with. Call us up and we'll see if we can structure it with you and with the buyer. The rest of it is just the typical renovation purchase, which you know, obviously. Refinance. So you have somebody that's a prior customer, they're asking about financing. We help with refinance transactions. The last two are really last resort. So bridge financing, hard money, where people are really somewhat desperate. They've got equity, but they don't have maybe numbers that work. We have lenders that will take out the loan, give them time to get their financials in order, and then come back and refinance in a year or so. So again, those are usually they're definitely not good rates, but they sometimes stave off foreclosure or something worse. I'm not going to get into a whole lot of detail about how we evaluate properties, but I will tell you this is kind of the basics of what we look at. We don't really care about the return on investment for the borrower, as you can imagine. We represent the lender, so they're looking at numbers like net operating income. So we're going to need some detailed information from the seller that you typically wouldn't ask for from a residential seller. So in the case of a commercial property, we need to know what the expenses are for the property and what the revenue is for the property. That's how we can actually determine what your buyer can afford. So in most cases, the seller is going to be asked to put this information up front. It's very important that you understand that, because you don't want to take a listing and then have to go back a month later and ask for the information when you have a legitimate buyer. You want to let the seller know that this information is eventually going to be asked and really required from any lender that's going to finance a property. And that's whether it's me or anybody else. But it's really critical if you can just remember that getting the information from the seller is absolutely necessary for any commercial property. All right. Everybody probably knows what a capitalization rate is here. We go through the math on that. And then finally, debt service coverage is the way we evaluate the property. So in other words, how the net operating income compares to the mortgage payment. So we want to make sure that it exceeds the mortgage payment by anywhere from 20 to 50%. And again, that varies by property type, varies by lender. So as lenders are flush with cash right now, we're seeing that a lot of them are down to the 20% in excess of the mortgage payment. Is as the lenders run out of money, or they not run out of money, but as they become depleted on funds that they can actually lend, and they're going to go back up to the 101.5 standard for a better quality loan. And then the last part is the documents we require. So again, this is something that you can just tear out and keep it with you. So if you ever come across a multifamily or mixed-use property, you can hand it to the seller and say, these are the documents that we eventually need to see. So the first two are pretty easy to get: the rent roll and actual operating expenses. Those are critical. You have to get those. The 3 years tax returns is something we want, but you can put a check mark next to that. That's something that we don't always get, and sometimes sellers are reluctant to provide that. And then finally, the personal financial statement refers to the buyer. We do want to know who the buyer is. We'll pull a credit report up, but again, the weight of the transaction is really on the commercial property as opposed to the borrower. So that's it on commercial. Do you have questions I can answer for you? Anybody have any transactions they've been thinking about or working on currently?
What is the minimum down payment and the credit score, I guess?
Yeah, so the credit score, again, we're looking at maybe minimum of 650, somewhere in that vicinity. It does vary depending upon the program. We've got a guy in right now who's got horrendous credit, but he's got a lot of equity, so they're not so focused on that. The down payment requirement usually varies. So we talk about the business, like the flower shop is the example I use. It could be anything, but if it's a business-related property with the person's business occupying the property, if they occupy 51% of the property or more, it's owner-occupied and therefore 10% down. If they're coming in as an investor, we're looking at, standard is usually 25%. We do have some that will go to 20%, but those are a little bit unusual. Like the church, one of the churches I'm doing right now is a 20% down payment. But 25% is somewhat the standard right now.
Thank you.
All right, so I've got one other thing I'm going to touch on real quickly, and that's co-ops. So this is pertaining to Brenda's domain, but again, my background was co-op financing, so just some important things you should be aware of. I'm sorry, Stan?
Before we
Yes.
go to residential, so you do a 504 program?
Yes. Yep, we do.
You do well?
Yeah, we have lenders that's what they do. They do all day, every day. So if I have an SBA loan, I will call them up and go through the details, and then they'll call back and we walk through it, and then eventually they'll send me a list of documents that they need to get to put the transaction together. Yeah, so the two people I work with primarily on it, one has been in the industry for as long as I have, so 30 plus years, and then the other one I have not met, but she's been in it for a number of years. So there's one bank and then one mortgage company.
Okay, the other question, church case. So usually, church, you deal with the trustee, or how you deal with let's say buyers?
Right. So the ones I have right now, they're basically two transactions in process. Another one is asking about it. So what they have is they have ministers or pastors have called me up and said they've come to the conclusion that their growth is so substantial and they're tired of paying rent, they want to buy a building. So what they've done is they have to go before the board and decide that they want to buy a building. They come to us with their financials. So we need the actual income statement for the last 3 years, like we would for any business. So with most churches, they don't file a tax return, so it's not audited, and that's pretty typical for a church. But we have to show that they have a bookkeeper, that they've balanced their checking account, so forth. They provide us financial statements, current bank statements, and then we go back and match it up against the potential purchase price on the property against operating expenses. So we talked about that, and then we determine what kind of mortgage they can qualify for based upon the income from the church.
So who is going to be actually signer?
It's actually the church. So in one case we have, they don't require a personal guarantor on this one transaction. The other one they do. So it could be a pastor or it could be somebody that's part of the church. So obviously the pastor's maybe not the most sound person financially, but there may be somebody in the church that's pretty well heeled, and they could be a personal guarantor on that too. Okay, so the co-op again. If you look toward the back here, there's we have the typical co-op right now requires only 95% financing. We do have one program that allows 3% down for people that are lower income. So I know there's a couple of low-income transactions around this area that we can work on 3%, but typically 5% is okay, as long as the co-op bylaws allow for it. So everybody's familiar with that part of the. Has anybody worked on a co-op before? You probably had. Okay, everything was okay on that. Okay, so. With co-ops, it's a little bit different. We obviously evaluate the borrower, and then we evaluate the co-op, and then the co-op evaluates the borrower. So what we do is we try to streamline this so we get the commitment letter to you as quickly as possible so you can get the borrower into the co-op board interview as quickly as possible. But an important change recently is that Fannie Mae always had a standard for New Jersey that was different than it was for New York City. So in New York, you always had a 51% owner occupancy ratio for an acceptable co-op. New Jersey, the threshold was always 80%. So recently, Fannie Mae came back and said they'll take 51% owner occupancy, which means that all these buildings that at some point over the last 10 years were deemed non-warrantable by Fannie Mae, they're now warrantable, which means that you've got a whole pool of buyers that can go in and buy and get financing right now that's not going to be outrageously high. So that's an important distinction. The debt-to-income ratio for us is 45% for a co-op, and obviously the bylaws may dictate something different than that, so they may have a 35% standard. If you have problems calculating that, call Brenda up and she can walk you through how we calculate that. But it's important to know that our standard is going to be probably a little bit more lenient than the co-op. So when you're selling a co-op, make sure that you determine what the bylaws require for that particular building, because they do vary by building. We're looking at the co-op and how to evaluate the building itself. So we look at these items: 3 years audited financials. We look at the declarations page for the master insurance policy. We look at the budget, and then we get a questionnaire. And again, Brenda would eventually get this information from the management company, but just so you know, if you had that information, you can pass it along to her. She can get the co-op approved before you take a listing or before you sign a contract on a property. And then the last page is red flags. So these are important because they're not unique to my company. They're pretty much standards for the industry. But the things that make a co-op what we call non-warrantable are right here. So if you have more than a 50% investor concentration, so you have a lot of rentals, that means it's non-warrantable. It's not going to be able to go to Fannie Mae. So financing may still be available, but they'll probably be required to have 20% down, have to have better credit, and they won't have a fixed rate available to them. So that's important. If there's pending litigation against the building, so it could be something minor like a slip and fall in front of the building. Insurance policies quite often take care of the litigation, but we want to know what the litigation involves. And often enough, it's just a letter from the management company stating what the litigation is, and then we get a letter from the insurance company that they're going to cover the claim, and we're good to go. So again, not necessarily a deal breaker, but it's something we have to address. Smaller buildings quite often don't have financials that are audited. So this is something that is definitely taboo in our industry. We need audited financials. So the bigger buildings, you never run into a problem. The smaller ones, I've seen handwritten financials which did not fly, as you can imagine. We want to make sure there's a budget for the fiscal year. So we want to make sure that we're in the 2019 year. We want to know what the budget is for this year, that they're intending to make a little bit of money every year, but definitely not lose money. We look at insurance policies to make sure they have adequate fidelity, liability, umbrella policy, if there's elevator coverage, if there's an elevator. And we haven't run into that recently, but the other thing we sometimes run into is multiple complexes are under one policy are definitely not acceptable. So it used to be that you'd have one management company that had 10 different complexes. They would try to bundle them up under one insurance policy, and that is definitely not acceptable any longer. Underlying mortgages. So buildings that have an underlying mortgage for the entire building are, typically those run for 10 years. If we're in the final 6 months of that, the building has probably started to refinance that mortgage. And what we need to see are what the payments are going to be on that, because it could affect the maintenance fee for your buyer. So it's very important that if you see an underlying mortgage that's becoming due, again, we can help refinance it. But if they're already in the stage of refinancing with somebody else, you want to see what the terms are of that, so we can determine if there's an increase in maintenance fee that's going to affect the debt-to-income ratio that we have to calculate. If you have a building with more than 25% commercial, that's a problem. And we don't see it too often, but I can say that the one really common person that developed a property like that was Donald Trump. He's got a bunch of buildings that have way too much commercial space, so we had a few of those problems. And then finally, one person with more than 10% ownership. So you have somebody that's become an investor in a particular building. We want to make sure that they don't have more than 10%, because if they go into default on all of them, that becomes a problem for your buyer eventually. But again, these are the red flags. We send out a questionnaire, and these are the things that come back. Those are the highlights that we look at. If you see it, you'll know that there's a problem. But if you see that these things are not evident in the co-op that you're working on, then you should have a good transaction.
If any questions, will be here. That's the end of our presentation. We want to empower each and every one of you so that when you go out into, I know you guys are trying to sell homes, but you also want to know the mortgage, because you don't want to waste your time with people who are not qualified to purchase. And the best thing to do is to save time is money. So if you know any opportunity in commercial, these are just ideas to have, and then if you have any question, please feel free to call me. And I know you mentioned about Michael Kim. At Hudson, we are here for your benefit, meaning that as a professional, not one person fit all, right? We're not a dictatorship. So you have many different options, and we give you many different types of people so that you know your buyer, who they can work best with, because mortgage is a very intimate type of relationship. We need to know a lot of information about the other person. They need to feel comfortable. It is our job to make sure that we create the best and structure the best loan for your customer so that they will be satisfied with your purchase, and that they will have come back to make sure that you will be successful. That's why we have many different types of people for you to pick and choose, and hopefully, so yes.
Question. Often we have some difficulties to get the condo questionnaire because it's sometimes a small building or sometimes buyer doesn't know and also seller doesn't know much about condo.
We harass them. We're very good at harassing management companies.
That's my question. So
Yeah.
you would, as a mortgage broker,
Right.
will help that.
Of course.
Yes.
Some mortgage broker they don't know. They just give it to
No,
the buyer
no,
and
no,
that's
no.
it.
No, because
Yeah.
we don't get paid until you go closing.
Yeah.
We go together to closing, pick up that check. That's what we do, and that is our job. Our job is to make sure you close sale. Whatever it takes for you to close your sale, that's our job, and that's our passion, and that's why we've been he's been in the industry for 30 years, and so we're very excited. I bring the best for the people so that you guys will be empowered. So that is our goal. So hopefully this presentation, it is not something new, it is just guidelines. And there's always, hidden secrets that Pat has and we have that we cannot share openly, but we will always be here for you. So please take our business card, and we would love to have opportunities, and we look forward to a very strong market, right?
That's right.
And we're ready to work, so, yeah.
Thank you.
Thank you very
Thank you.
much.